Welcome to our webinar on the CEE Top 500 ranking, the comprehensive list of the largest companies in Central and Eastern Europe. Thank you for joining us today. The Coface CEE Top 500 study provides an in-depth look at the data, at the trends and stories behind these headline figures. Which companies are emerging as leaders? How are industries adapting to future challenges? And what insights can businesses across CEE take away? My name is Verena Schwarz. I'm Communications Manager for Coface Central and Eastern Europe, and I'm very proud to host this session together with our two esteemed colleagues. First, let me introduce Mateusz Dadej, our regional economist at Coface. Mateusz will walk us through the key findings of the ranking and share his perspective on the economic implications for business environment. Thank you, Mateusz, for being with us today, and hello.
Hello, everyone.
Next, I'd like to welcome Matei Mihailescu, our Regional Business Information Director. Matei will provide a deep dive into the data and explain how this information can support you in your risk management strategies. Hello, Matei.
Hello, everyone. Thank you, Verena, for having me.
Before we begin, a few practical notes for you. You can interact with us and submit questions at any time during the presentation. On your screen, you should see a control panel on the upper right corner. In the question section, simply type in your questions. We will collect all of them and address them during the Q&A session after the presentations. And in the handout sections, another icon in the control panel, you will find the booklet of the CEE Top 500 ranking. Feel free to download it at any point during the webinar. In the next days, you will also receive a follow-up email with the booklets, the slide of today's presentation, but also a recording of the session. And now I'd like to hand over to Matei for an introduction to the 17th edition of the CEE Top 500 ranking. I wish you an insightful webinar.
Thank you again, Verena. So what is the methodologies that we have used? We are gathering all the financial data of companies in Central Europe. We are trying to compare countries as much as possible like for like. So we are focusing on Central and Eastern European countries from Bulgaria down to Poland up in the left, Czechia and Hungary, and in the right, let's say, Romania. We are grouping these companies based on the last published turnover of the year of 2024. We are not including financial institutions because they have a kind of different way of measuring the performance. And if there was any company big enough but not publishing in due time the financials, we also took the decision not to list those companies inside. And we gathered for these companies the main indicators: turnovers, net profits, employment data, and we have used the FX rate exchange at the end of 2024 whenever we transform the figures, because half of the companies, half of the countries in our study, they are on euro, half of the countries they are on local currency. So this is a bit of methodology for our data gathering.
Right. And yeah, I will, as Verena mentioned, I will briefly or thoroughly maybe give you a walk through our ranking. So I'm an economist, so I will definitely try to give some macroeconomic background to the ranking, to the changes, or what has happened with the biggest companies in our region. And yeah, I think it's good to start with some background, macroeconomic background. What has been the economic environment that was the biggest companies were working in. So 2024 was overall a rather good year when it comes to economic growth. For a lot of the countries, we have seen an acceleration of their growth rates. So definitely Poland, right, reaching close to 3% of year-over-year growth rate. much higher than the previous 2023, barely almost a stagnation levels. Yeah, basically all of the Baltic states has seen acceleration. We have seen also a very substantial growth improvement in Lithuania, and also for many south central countries we have seen a maintain that they maintain their pretty impressive growth rate. So for example, Serbia, Croatia, and an improvement in Bulgaria. And that was yet another year of a pretty impressive rebound. So as you can see on the right chart, the cumulative growth rate is basically above pre-pandemic levels for all of the countries in the region, with the fastest growing, the fastest rebounding from in Croatia, Serbia, and Poland. So Croatia was benefiting a lot with the EU funds. Serbia still maintains a lot of they hold a lot of economic convergence premium, so they were that's usually one of the least developed countries, and usually those less developed countries are developing faster. But next to that, of course, Serbia saw a huge inflow of foreign direct investments, which was boosting the growth rates. On the other side of this so-called, you could say, a spectrum, we can see that, for example, a lot of the countries that are closely related to German supply chains, so for example, Czechia, Hungary, Slovakia, and Austria, they were actually having a very subdued growth, especially after the energy crisis in 2022. And yeah, so definitely the past few years have been very volatile. A lot of people call it poly-crisis times. And it definitely shows to some extent in the insolvencies. After the pandemic, counterintuitively, one could say that we have seen a fall in insolvencies. Yet that's easily explainable given the huge fiscal measures that were aimed at freezing the employment layoffs, right? So basically, the government were helping the corporate sector to kind of offset the lockdowns that were aimed at curbing the pandemic, right? And counterintuitively, we have seen a fall in the insolvencies in 2020. Then we have had a another substantial crisis. So following the aggression of Russia, we have seen an energy crisis in 2022. The previous fiscal measures were withdrawn. The energy prices has skyrocketed, and the results are absolutely dire, right? So you can see the increase in insolvencies in 2022, 2023, up until 2024. Our kind of period of reference, right? So we have seen a kind of stabilization at a very record levels, or at least a decade high levels. Then coming to actually the results of our ranking, right? Here we can see the table that's actually directly taken from our booklet, right? Those are top 10 companies in our region. So there are a few changes, but at least at the podium, we have seen only a single one. So the first company is Orlen, basically an energy company. So oil refinery. Everyone, if we have any kind of Polish attendees, I'm sure they are familiar with them. Orlen works also under different brands outside of Poland. Then we have Skoda Auto, of course, everyone knows the car manufacturer, right? And then a new company at the podium, Jeronimo Martins Polska. I think as much as the name of the company may not be that familiar, but the brand Biedronka, which is a retail store, is basically seen everywhere in Poland. And even though that's a Portuguese company. And of course, they benefited a lot. That's a trade company, so they benefited a lot with a really substantial consumption rebound in Poland. Then we see a MOL, that's another energy and oil refiner company from Hungary. And then Totalizator Sportowy, which is basically a betting company from Poland, state-owned betting company. another big one company. And then we have a lot of also car manufacturers and energy companies. So Volkswagen, of course, Lidl, which is another retailer, Audi, so a car manufacturer, or at least a subsidiary in Hungary. So a lot of the companies, but I think the common thread is that there are basically three biggest sectors, which is automotive, retail, and energy sector. And then, yeah, we can see some aggregate statistics of the ranking. So Poland, being the biggest economy in the region, is of course seeing the highest amount of the constituents, so the companies that are listed on our ranking, right? So in Poland we have listed around 178 companies, over twice with respect to the second second economy, so Czechia 71, and then Hungary 61. So it's more or less, we could say, correlated with the size of the economy, right? Although there are some, you could say, outliers. So, for example, Romania, despite being, at least in terms of population, but also, I mean, in terms of just the sheer size of the economy, Romania is the second biggest CEE economy in the region, and yet they only have a fourth number of the constituents, which is 56. All right, we just also say this about Serbia, 15. But of course, Serbia is not currently in the European Union. Therefore, they may have some issues in terms of developing a big, like, multinational companies. And then so we could also see the change in terms of the constituents, the number of companies in our ranking. So Poland has seen the biggest decrease in the number of the companies. So that's less than with respect to the previous year by 6. And then this kind of fall was spread almost more or less evenly across. So the economies that actually have seen increase in terms of the companies is Czechia, Romania, Bulgaria, and Lithuania, and Estonia as well. Also, we have seen a fall in Hungary and Slovakia. Actually, some of the countries that one could say had one of the bigger kind of economic problems, and it's also reflected in the way that in the number of entities listed. Then, I think that's also, so here on the chart, you can see the number of entities in the top 500 by the sector. And as I already mentioned, and actually anyone could see from the top 10, some of the biggest sectors are, the most represented, which are basically basically mineral products, chemicals, petroleum. So those are mostly big oil, petroleum refiners that are, the most numerous. And then we have the car makers, of course, and then there's no specialized trade, so usually retailers. Also some sectors that are pretty well listed are electrical equipments and utilities. And then we can speak a bit about the financial results of the, at least in an aggregated level. So, we have seen a lot of the actually fall in terms of revenues. So, for example, mineral products and basically the big oil companies have seen a substantial decrease in their total revenue with respect to 2023. This sector, together with the utilities and public services, have seen basically we're ranging on the total revenue in our ranking, especially the utilities. But yet some of the other basically sectors were benefiting on the increasing or rebound in consumption, rebound of the purchasing power of the households, and that's a non-specialized trade, right? So basically those following the substantial disinflation in 2023, 2024, we have seen an improvement in purchasing power of the households, right? So the prices were no longer increasing so fast, and yet the nominal wages were increasing rather fast. They were rebounding following a rather hard times during the energy crisis, and this kind of increase in purchasing power benefited especially the non-specialized trade, right? So that's one of actually the sector that has seen the biggest increase in revenues. And yeah, as I mentioned, I think it's important to maybe give a few comments on the energy sector and the utilities, kind of try to explain what's going on in terms of their revenues, how did they really develop throughout 2024. So yeah, following the basically energy crisis, we have seen a substantial well, a shortages of some of the energy commodities. So basically, yeah, we are facing, so Europe in general, we're phasing out the Russian supply of the energy commodities, especially gas commodities. And because of that, we still have seen a substantial demand, aggregated demand for energy, and yet the supplies were scarce. They were very much restricted. And what the refineries were usually doing, well, they were basically increasing their refinery margins a lot, as you can see on the left chart. So especially also Europe, but also other, actually, it was a global phenomena. But then the kind of energy crisis has stabilized to some extent. We can also see this by the energy commodity prices on the right chart, that after 2022, we had seen a gradual, well, a very fast in 2023, and then a bit slower, but still a decrease in energy commodities in 2024. So we have seen a normalization of energy sector, and the results in 2024 are, of course, reflected very well in the aggregated financial ratios of the companies, right? So well, there is one effect on the revenue, so that's a price effect. So the energy prices were basically normalized. So of course, that's even if the volume has stayed constant, the price effect was weighing on the revenues, both for the utility sector, but also for the energy sector, or the oil refinery sector, right? And yeah, it's especially, you can see this on the refinery margins, which was gradually well, decreasing in 2023, then in 2024 even more so.
Listening to aggregated figures and to consolidation of all the top 500 companies, we started to analyze the data in the way to check how did the companies performed per segment. So what we did, we took the companies which are showing in 2024 a higher profitability than previous year. What we observe here, we observe that 46%, so let's say half of the ranking, they are showing a higher profitability. What happened inside these companies showing a higher profitability, the value of profit increase was 34%, which means from 17 billion to 23 billion euros. And we were also looking what these companies have done in terms of turnover, and we saw that the turnover pace, it's a bit smaller, 4.2%, so up to 450 billion euros. An interesting information, maybe a bit negative, is that doing the same 1 year ago, we observed that we had 55% companies showing a higher profitability, 23 over 22. And the change in net profit was 130%. So listening to Mateusz, it's clear it was a tougher year for the companies, even for such big companies. Moving on the turnover side, 58% of the companies, 290, were showing a higher turnover versus previous year. How much? 12% was the change in the turnover for this company. So from 508 to 500 and almost 70 billion euros. By the way, the year before, the change in turnover was almost double. 21% was the percentage of turnover increase. And the change in profits for these companies this year is 25%, which is much better than the previous year. The previous year, the change in profit was only 4%. What does it mean for us? It means that in 23 versus 22 companies were sacrificing the profit margin for the sake of turnover, while this year they started to capitalize on the turnover from these 2 years, and this was also confirmed by the good performance in terms of profitability. And the third element, because we want to also understand the kind of social impact of such companies, we see that companies showing higher net profit in 2024, they are hiring 40% of the whole employment base within this ranking, while companies showing higher turnover, they hire 60% of all the companies in this ranking. It's just by coincidence, 40 and 60%, these are totally different figures. So that would be a snapshot on how good the profits shifted for the companies which were able to show higher profitability, and how big the turnover was higher than the previous year for the companies which are showing a higher turnover.
Right. Thank you, Matei. Yeah, so another kind of very interesting, I think, financial ratio, or a kind of a measure that's of interest to a lot of people is basically margin rates across the sectors of top 500. So that's so the chart only shows the sectors with 4 or more constituents, so that we actually have some to some extent a representative sample possibly. And well, so the first things is that it's clear, but I think to many people, that many actually sectors have in general a lower or higher margin rates, right? So we have seen a sectors, for example, construction, which usually or more or less have the highest margin rates across the sectors, right? Then we have utilities, actually pretty big, pretty high one. Then the conglomerates, a rather ambiguous sector. Usually those are companies with many different subsidiaries operating in rather separate, often separate but not necessarily sectors or segments. And then I think it's also well clear. I think that's more of a cyclical maybe phenomenon, but the metals producers have seen the worst actually level of margin rates, and that's, yeah, of course, a lot of the factors, but some of them is, well, first of all, we are seeing a very well subdued or rather weak demand coming from the industry industry sector. Of course, metals are usually, well, some of the biggest demand is of course from the industry, so metals are definitely not in the best position. Some of the other things, especially kind of weighing on the margins, is of course the increase in the competition from China. So for example, China is basically since some time ago already kind of struggling with this overproduction. So basically they really have a problem with aggregated demand. So the consumer is very weak in China, so weak that the kind of local manufacturers are required to kind of seek alternative markets outside of China. At the same time, spilling their overproduction, but also deflating prices outside of China, for example, to Europe. So one could say they are basically exporting their deflation. And of course, China is actually the biggest producers in the metal sectors, especially steel. And that's definitely this increase in the competition is waging on the sector. It's one of the hardest hit sectors recently. And yeah, I think for non-specialized trade, on the other hand, it's rather typical. That's basically a sector that's operating on on a razor thin margins, so a bit above, a bit above 2%. And then I think what's also interesting, other than the only level of margin rates, is that for most of the sectors we have seen a decrease in margin rates, right? So you can see basically the green points are margin rates for 2023, right? And the blue or light blue points are the margin rates for 2024. And for most of the sectors, the blue dot is actually, well, much on the left side rather than the green, right? So it means that basically for most of the sectors, the margin rates have decreased. And yeah, I think it's a phenomenon that's to some extent explainable when we look at the macroeconomics of the basically the macroeconomics of the region. I think I already mentioned a hint of what's going on. So yeah, basically 2022 we have seen a record inflation. Then 2023 and 2024 especially, we have seen a huge disinflation, right? So the inflation basically fell just as fast as it was increasing in 2021, 2022. And well, on one hand, we have seen a rather stable inflation rate, stable increase in prices. But on the other hand, well, the nominal wages were increasing very fast. So as you can see on the left chart, that's the increase in unit cost of labor in CE5, the nominal one. So basically, combined with a falling inflation and well, a still substantial increase in nominal wages, that's of course results in a very fast real growth of nominal wages, or a real growth of the purchasing power, right? Yeah, I think that this kind of delayed nominal wage growth is usually due to the fact that basically the workers have a bit lower negotiating power, right? So it's much easier for companies to increase their prices, well, rather than for the workers to increase their wages or kind of negotiate higher wages. And so usually this kind of increase or this kind of stabilization on the labor market is delayed. But a bit much more delayed actually than the increase in the prices. And yeah, so basically 2024 we have seen this kind of normalization of this phenomena. We have seen this kind of a very substantial increase in purchasing power. It resulted, of course, in much higher consumption rates, right? We have seen a very much a substantial increase in retail trade. We have seen basically across the region a main economic driver was the consumption, private consumption of the households, and so that's basically why we have seen a rather for a lot of the countries an impressive economic growth. Especially for other countries, an impressive rebound from a rather low economic growth levels. And yet, the situation for the corporate sector was not as lovely as it was for a consumer. So on the right chart, we can see the kind of consequence of this combined dynamics in the macroeconomic environment. So basically, for most in the biggest economies in the region, we have seen actually a fall in the profit share of non-financial companies, right? So, for example, in Poland, at some point in 2024, it reached actually levels not seen. Last time seen maybe in 2012, right? So that was at the peak of the sovereign debt crisis. And yeah, so basically 2024, that was pretty hard for the corporate sector. And what I think is really interesting is that it's well reflected in the ranking that we have collected in the list, in the ranking of the companies. But it's also clear that that those are the biggest companies, and they are definitely the macroeconomic winds or the macroeconomic trends are really reflected in their financials, right? So yeah.
So macroeconomic trends, geopolitical impacts, profits, costs, they all land with a certain impact in the performance of each company. So we have analyzed the performance of these top 500 companies, and I could share some findings, some of them positive, some of them, let's say, stable versus the previous year. The first one is that more or less same number of companies had a positive evolution versus a negative one. 58 versus 65, I believe we can call it as stable. If I would look on the previous year, there were more companies with a positive evolution than with negative. So let's say it's not necessarily a good trend, but listening to Mateusz, that the overall profitability of top 500 companies went down, we can also understand why. For us, of course, profitability is an important indicator to assess a company. Then what we see on the red figures, we see that 6 companies went from last year, and you see these scores on the horizontal part, from a green or orange level, which means a good score or a medium high risk, they went to high risk, to the red category. If you check this on the vertical, yes, so on the horizontal we see the score 1 year ago, and on the vertical we see the scores that we are observing today. So 6 companies went to the red category. Then one other interesting to watch is the second group of companies, the second square, with companies which were on low risk, on green the previous year, and today they are on medium high risk, which means the score of 4 or 5 within Coface. And there are, of course, some positives. It happens, it's good. So we see companies on the right square. You see companies which they had a better performance during the last year, which made our analysts to score them from previously very high risk or medium high risk now to a good score. So again, it's a balance of companies evolving good or bad. Of course, some companies have been helped by their own efforts. Some companies have been helped by the inflation. They were able to transfer into the consumer price, while other companies have struggled a bit more. So all in all, this is a snapshot on the score evolution. The total average score of top 500 companies is 6.15, if my memory is correct, Mateusz, which is on the green part. Yes, so in this respect, overall, we can say that big companies, they handle quite well their performance, but these are the changes inside. And on the next page, you will see that one company is showing today a score of 1, downgraded by Coface from previous year 4. This is not good news, because a company with a score of 1, it represents a high risk of potential financial not meeting its financial obligations. But let's see the positive side. Last year, on the same period, on the same slide, we were showing one company going already insolvent. So at least in the last 12 months, there is no company in the top 500 which went insolvent.
Yeah, so that's definitely the case, right? Basically, for a lot of the companies, I think the biggest companies are usually pretty resilient in terms of any kind of macroeconomic headwinds, and they can often, they usually have a better kind of bargaining position, better position to negotiate higher prices, and it shows, right? So I think that's basically one side of the whole story of the a pretty dire situation of the corporate sector, but it's nonetheless interesting to see the dynamics of the financial conditions of them. And then we also collected the data on the employment of the biggest companies in the region. And I think it's really interesting to see that for all of them, they actually hold a significant portion of the economy of the employment, right? So we can see the countries, for example, like in Lithuania, they actually hold the biggest companies from Lithuania actually hold over 10% of the employment, or are responsible for around that much of the employment. And for a lot of the countries, we also have seen actually an increase in terms of number of employees. So that's especially for Estonia, Czech Republic, Slovenia, and Croatia, right? And on the other hand, there are not that many countries, not that many companies that were actually decreasing their employment, right? So, for example, Poland, basically stayed constant. I think the only country maybe with similar dynamics is in Romania and Slovakia. And I think also what's interesting is what I also mentioned before, right? So there are some countries that are actually, their biggest companies actually don't reflect that much the whole economy, right? So we can see this disproportion in Romania, for example, to a lower extent even in Bulgaria and Latvia. For Latvia especially, it's often the case that we are seeing actually a company is listed or registered in a different country, but yet operating in some of those countries. So I think this measure is to some extent, one could say, a proxy of this kind of unemployment, or a kind of how much they actually hold share in the total economy, right? And so for other countries, we also see Poland a very substantial share. So basically over 7% of the employment of the top biggest companies listed in the ranking, or the biggest companies from Poland are actually holding the total employment, right? So those are absolutely huge numbers. And given this, it seems really unsurprising that a lot of the macroeconomic trends that we have seen so far and we are experiencing is actually reflected in those, across those companies. And then so basically the labor market has been, in general improving, right? So as I mentioned, side of this is that we have seen a huge increase in the nominal wages, but that was also kind of in parallel with overall a fall in some of the unemployment rates. So that's definitely to be seen in Poland, Bulgaria, Croatia, Lithuania, and to some lower extent in Slovakia as well. So those are the countries with that has seen a lower unemployment rates. I think it's especially good to see this combined with an increase in nominal wages, right? And then, talking about the employment in CEE region, we're actually seeing this trend actually since the pre-pandemic times. So the employment is mostly increasing in the CEE region. So for a lot of the countries, at least so far, they have benefited with the rather good demographic conditions. On the other hand, Bulgaria is actually one of the few countries. Not all of them were actually represented on the right chart, but one of the few countries that have seen a almost stagnating level of employment. And the biggest ones going for Lithuania. For Poland, I think the measure is a bit underestimated for some of the countries, given the inflow of the Ukrainian migration following the Russian aggression, right? So those are usually the rather official statistics. Still, the statistical offices have a bit of a hard time kind of estimating the Ukrainian inflows, but they have definitely been a almost a game changer for the local economies since 2022. So they have improved the labor market, the labor force of the economies in the region. Also to the benefit of course, the biggest companies in our ranking, because on one hand side, a lot of them were struggling on a very tight labor market, especially as I mentioned in Poland, Czechia, and Slovenia. So labor shortages were one of the factors that were mostly listed by the companies as factors that were limiting their development. So on one hand side, we have seen so this increase in employment is very beneficial, because the companies are actually able to increase their employment amid a very tight labor markets. And on the other hand side, of course, that just simply mean that the local economies are bigger, they have a bigger domestic market, and for the corporate sector, that just means that even if their market share constant, they experience basically an increase in the market. So that's definitely positive for the revenues. And then, talking a bit about some of the macroeconomic trends that has happened and are happening actually. So a bit of a hint of what we can see in the next perhaps ranking, and what's going on, what are the current kind of issues experiencing by the corporate sector. So of course, I think it's interesting, worthy to mention, given that, as we can see, a lot of the biggest companies are basically car makers, subsidiary car makers of some of the biggest concerns or biggest companies from Western Europe. And of course, the manufacturing production in Western Europe has been for Germany, it has been a disastrous, one could say. So especially the latest data in August. So we are actually seeing a constant recession since 2022. Germany was definitely not well positioned for this phase out of, first of all, for the Russian aggression, and then for the phase out of the energy supplies from Russia. And it's definitely reflected in their energy prices, and definitely in the pre-energy intensive energy intensive manufacturing there in Germany. But that's also the situation in other countries in Western Europe has not been much better. I mean, they are also either stagnant or a bit less recessionary, as in Italy, and that's of course waging on the car manufacturers in a CEE country, right? So those companies that we have seen also in the top 10 biggest companies in the region, they are of course very much dependent on the kind of manufacturing plans decided by the organization headquarters. So that's definitely a tailwind. And we basically are seeing also a pretty subdued new orders in manufacturing industry. So that's also it doesn't give a very much optimistic view so far. And we are going in this. We are basically almost started, or it started in April. We have seen the trade wars going on, kind of an emergence of another round. You could say trade wars 2.0. Initiated by Donald Trump. So that's definitely another tailwind for manufacturing sector in the region. And looking forward, I think it's a bit more optimistic, especially given one could say a breakthrough in terms of fiscal policy in Germany. So actually they decided to support their economy following a few years of stagnation. They decided to support their economy with the huge fiscal measures, and I think this will have a profound impact on our region. Of course, one thing is already to be seen, right? We are just located in the region. We have located a lot of the subsidiaries of the car makers, but also any kind of demand from Germany, from German construction sector or German industry. It's also, of course, a benefit of many suppliers from our region. So I think that's the most optimistic factor that may take place further on. And then also, I think what has been an important factor for all of the countries. So actually, 2024, on average, we have seen a higher levels of the interest rates. So of course, the interest rates basically started to increase for all of the countries in 2022. But then they reached their peak just somewhere in between 2023 and 2024. So of course, those are a higher cost of financing has several implications for corporate sectors. One thing is, of course, a more leveraged companies, they are seeing their debt service cost increasing, right? And that's following already a few years of this accumulated debt, debt services. On the other hand, of course, that's it's waging on the total economy, right? So the consumer has to spend much more on their mortgage. On the other hand, other companies or corporate sector in general is maybe delaying or not deciding for a lot of the investment projects because of the higher cost of financing, so a bit higher expected or necessary rate of return from the project, and that's of course is waging on the demand of many so for example, that's especially to be seen on the construction sector that's experiencing a rather subdued level of new orders, for example, from manufacturing sector, but also from basically from the households. So it has several implications, right? We had also seen this. That was one of the factors actually behind the falling margin rates in the ranking across the sectors. Of course, some of those sectors are a bit much more leveraged and has experienced a bit more of those elevated interest rates. But then looking forward, we can already see that many central banks, also in the region, but also in the ECB, so that's also some way overlapping with the current region. So that's we already see some monetary easing going forward, and yet so far I think the central banks decided to maybe keep this a bit more neutral stance, so they are a bit much more hesitant to decrease the interest rates further, but yet the interest rates are definitely lower than they have been at the moment of the biggest inflation. But then looking forward, of course, the sovereign interest rate, so a bit more long end terms, so 10-year basically, is actually not willing to decrease. So following the 2021, 2022, we have seen a huge increase in the sovereign interest rates. So the long end, for example, the interest rates, for example, of the mortgage rates are actually staying rather constant. And then just a few words of how do we as a Coface see the country and sector risk. So that's also to be expected, to be expected or to be reflected maybe in the either upcoming ranking, but a lot of the sectors are in such a position for some time already, also since 2024. So of course the construction sector, that's basically a high risk sector since already a few years. And it has to do, of course, with what I already mentioned, right? So the very elevated interest rates waging on the demand for example, mortgage financed housing, right? And then there are only few sectors that we are seeing to have a rather moderate level of risk or a low risk, and that's pharmaceuticals. Of course, that's a sector that's usually rather more usually the demand for pharmaceutical products are a bit less volatile. It's also less price sensitive, and that's important, especially in terms of trade wars, where we see this price kind of channel of tariffs definitely damaging the consumer, especially in Western Europe, but also in the US. And then, yeah, we are seeing basically a lot of the manufacturing segments that are still high risk, and that's also kind of reflected in the ranking, right? So that's automotive sector, chemical, and textile, clothing, transport. Even though it's a service-based sector, it's of course facilitating the basically operation of the manufacturer of the manufacturing sector, and that's why this is one of the very high risk sectors. And I think that's all from my side. I think yeah.
That's my sign now. Thank you, Mateusz. Thank you, gentlemen, for sharing your insights with us. I actually want to remind everyone that you can ask questions now. So type in your question in the question section, and I will address them to our two speakers. But also a reminder, if you want to download the study, so the ranking itself, you can find it in the handout section. So the icon next to the question mark. You can download it now during the webinar, but also in the next days, you will receive an email with this booklet, with the slides of today's presentation, and with the recording of the session. And now I can see that we already have a few questions, which I will now read out loud, and I will ask the gentleman to answer the question. So the first one is, do you consider to group companies owned by the same international group and present the list like that? So that's more question on the technical.
Do you want Matei answer or should I?
Yeah. So I mean, there are different ways of, let's answer both. There are different ways of building any kind of ranking, and sometimes you cannot have always like for like basis. Several groups owning companies in top 500 Central Europe, they are not from CEE. So then the question comes, how to group? Do you compare Orlen, which is the biggest company, which is a big group in Central Europe, close to 70 billion euros, with whom? You compare with, I don't know, OMV, but only CEE OMV. So there is it's not perfect. It's not perfect. This is why we decided to compare real entities one by one, registered in these countries by the indicators that we can see individually.
Yeah, maybe I will add a few words. So yeah, of course, that's there is always some kind of trade-off in either grouping or not the companies. But I think this way, even if the kind of subsidiary is not locally owned and is a part of a wider group, they kind of reflect the kind of operations in a given country. So, you know, those companies still employ a lot of the companies. They are basically, well, they are operating in a market, in a local market. So they generally reflect the local economy, and in general the local market. So I think it's of course on one hand not owned, oftentimes not owned by the local company and are part of a wider group, but they still reflect. They are working on a market, on a local market. They sell often. They either sell to the local market or they export, but they still are kind of you know, working, operating in an economy, in a local economy, right?
Thank you, Mateusz. Another question to you. Which sectors do you see as they have the highest potential for companies in 2026?
Right. So I think you know, across the region we are seeing this monetary easing. The cost of financing is definitely much lower than a few years ago. I think this will come to a benefit to the construction sector especially, and you know, after a few years of almost a stagnation in a lot of the countries, but I think we will see a much increase in the demand, financed by the lower, well, of course, financed by the credit, but also we will see this demand being supported by lower interest rates. So that's one thing. We already, of course, see this in the countries who have seen actually a much earlier beginning of the monetary easing, and that's Czechia. So Czech National Bank actually decided to decrease their monetary easing amid a rather stagnant economy. But of course, the interest rate, the monetary easing usually has some delay in effect, some lags in how they work on the economy, and it takes some time. And we already see this in Czechia, that the construction sector is actually starting to rebound. I think this will come to many other countries in the region, that we will see probably a higher construction output, and that's one of the sectors I think we are. Well, I am monitoring closely, also because I believe we are seeing a lot of the inflows of the EU funds, and that's going to be for many countries the infrastructure projects. For a lot of the countries, well, actually, for all of the countries, 2026 is the last year of this kind of disbursement of the EU funds. So a lot of the funds will be basically front-loaded to this year, and this will benefit. This will be spent to a lot of extent to infrastructure projects.
Thank you. Another question to you, Mateusz. How do you see the development of automotive industry in CEE, having in mind strong influence which is coming from China?
Yes, that's definitely a hard task, a very challenging times in front of the automotive sectors locally. I believe, yeah, we might see a bit of rebound just at the tailwind of a general rebound of the manufacturing sectors in Europe. So there are some tailwinds. For example, actually, a lower interest rates do have consequences for automotive sector, because the leasing segment is very important for automotive demand. And with the lower cost of this, I believe we will see a bit higher demand. And yeah, also in general, a better improvement in terms of economic growth and economic business cycle. We'll see an improvement in terms of real wages, especially in Western Europe, which should perhaps increase some demand for automotive sector. But I think what's important to have in mind is that there are a lot of structural issues faced by the automotive sectors in Europe. So especially what you mentioned is that we are seeing an increase in Chinese competition. It turns out that they have a lot of competitive advantage in terms of production of the EVs. So one of them being they have better kind of supply to from those rare metals, right? Rare earth metals. Those are so China is one of the biggest producers of those rare earth metals. And also a lot of the Chinese car manufacturers, they actually started to develop themselves first as a supplier of a lot of those metals, then began the production of the lithium batteries, right? And then they started to produce the cars, the EVs. So they are basically built originally in order to make a very competitive EVs. So that's much harder for a domestic or European traditional car makers, which actually have to they need to revolutionize their kind of business model to make it more kind of oriented into EVs, which are of course the future. And I think that's a much harder task than just develop the companies from very bottom, from their very origin, to be the producers of EVs. So that's very complicated, and I think that's very much limit the possible rebound of the manufacturing sector in Europe.
Thank you so much, gentlemen, for these valuable insights. Thank you everyone for joining. Goodbye.